So I talk a lot about planning for your loved one's future, but it's crucial that you have a good handle on your financial life in order to do that. Now, a lot of times, either young families or singles, they believe that in order to grow their wealth and save for the future, they need to reduce their current standard of living. About 45% of millennials have student debt, and any excess money they have coming in usually goes to paying that off. Now, what if I told you that you didn't need to scale back in order to do this? What if we could find money that you are currently transferring unknowingly and unnecessarily, and we could bring those dollars back to your pocket so that you can pay off debt, save for the future, and keep your current standard of living? Hi, my name is Elizabeth, and for all the best information on special needs planning, make sure that you click that subscribe button and that notification bell to be notified anytime that I post new videos. So basically, there are three types of money. There is accumulated money, which is money that you have invested and are saving for the future for future needs and goals. There is lifestyle money, and this is the money that you use to fund your current lifestyle, places that you go to eat, places that you go to vacation, so on. And then there is transfer money. And this transfer money is money that you are losing unknowingly and unnecessarily. Now, being able to bring this transfer money back to your life would make the greatest impact on your future wealth. Now, avoiding these unnecessary transfers frees up money so you can bring it back and add more to your accumulated money and your lifestyle money. Now, without knowing any of your financial information, I would say you should be saving 20% of your gross income, have no debt except for your house, and live off of the other 80%. And then you may say you wouldn't be able to save 10% of your income, much less 20%. And that's where working with a financial professional that can help you find that money that you're transferring away becomes imperative. All right, so there are many ways that people can be transferring money unknowingly and unnecessarily, but we're only going to be talking about three today. And the first is major capital purchases. A major capital purchase is any lifestyle item that you purchase that cannot be fully paid for with your monthly cash flow. Things like cars, home improvements, medical expenses. And a lot of the ways that people end up purchasing these things is by borrowing, whether that's from credit cards or loans. Now, it's important to understand that whether you are purchasing the item using somebody else's money or borrowed money, or you pay cash, you are financing that item. If you do, in fact, pay cash, you may not be in debt, but you are using investable assets that could be earning interest for you. It's also important to know that you are depleting a tank of money that could have been used for family items or emergencies. Paying cash does create a financially secure position, but there are times when maybe a more secure position would be to purchase that item through financing while maintaining that savings account. Now, let's just walk through a quick scenario.
So you have $30,000 in an account earning 5% interest, and you decide that you want to purchase a $30,000 car. Now, if you decide to finance that car at 5% interest over 5 years, you're going to begin with the $30,000 in your account earning 5% interest and a $30,000 liability that you are paying 5% interest on. Now, your monthly payments will be $566.14, and you begin with a net worth of $0. Now, if you pay cash, then you begin with nothing in your account. So nothing is paying that 5% interest to you and no liability. So again, you're not paying that 5% interest. But what you will have to do is $566.14 of your cash flow is going to have to be contributed back into your account, and you end up with a beginning net worth of $0. Now, at the end of the first year, had you financed, your account balance would have grown to $31,535, and your liability would have dropped to $24,583, meaning that you have a net worth of $6,952. If you had paid cash, your monthly contributions back into your account plus interest would have grown to $6,952, resulting in the same net worth as financing. So what if you had accelerated payments on a loan? It's actually the same result. The car loan is paid off sooner, but the long-term financial position stays exactly the same. So really the only difference in these two scenarios is liquidity, which is the use and control of the existing account balance.
Okay, so next I want to talk about mortgages. Now, it's important to understand that wealth transfers are inevitable when you're purchasing a house. If you decide to finance, there's the obvious wealth transfer of interest. And if you pay cash, there's the wealth transfer that happens because the money in your account is no longer earning you interest. Okay, so there are 3 reasons to have a mortgage. The first reason is that you just don't have enough money in your bank account to purchase the home outright. Second reason is that the interest on your mortgage loan is tax deductible. And third is that you may be able to find a mortgage that costs you less money while your money in your accounts are earning more. So another factor to consider is the effect of inflation. Your dollars today are most valuable. So when you lock in a 30-year mortgage, you would benefit by not prepaying that mortgage with inflated dollars and keep that money invested. In 30 years, your house payment is going to feel significantly less than it does today. For example, if you have a monthly house payment of $1,200 today, in about 30 years, it's going to feel like $495. So this may apply to some of you may not. But something my husband and I have been talking about a lot lately is college planning. Now, our daughter's only 7 right now, and 18 feels super far away, but in reality, it's not. We've been talking about how in order to prepare financially, we need to understand what the true cost of college is before that first invoice arrives. On average, tuition rates are increasing at 6.5% per year, and that's double the rate of inflation. And we want to avoid sacrificing in other areas of our financial plan in order to not fall short for college funding. So when we do the planning, it's important to understand that an undergraduate degree is going to cost more than just the tuition. We need to understand what the cost of attendance is going to be. This includes tuition, room and board, the cost of books, transportation, fees, the list goes on. And on top of that, an undergraduate degree may take more than the conventional 4 years. It could take 5 or 6, and we need to be able to plan for that as well. So the typical path a parent takes when paying for their college-bound students kind of looks like this. First, they spend the money that they have specifically saved for college for their children. Then they might look for borrowing opportunities, maybe sometimes tapping into their home equity or their retirement plans. And then they might need to look for part-time work or start a new business to create more income. And then finally, they might apply for some financial aid. And while yes, this will usually result in a fully funded college expense, it may not be the most efficient way. So we believe the proper approach should be done in reverse. We believe that you should first be applying for financial aid and don't make any assumptions about what you would qualify for. And then second, you're going to need as much cash flow as possible because most of the time tuition costs more than was initially expected. Third, that's when we would look for borrowing opportunities, and we would be looking at the risks and the rewards from each individual account that you would be looking to tap into. And then finally, we would be depleting the assets. So you may have noticed a theme in all of my examples so far, and it's liquidity. Being able to have control over your assets is key to financial success, and being able to hold on to them for as long as possible gives you the most control. I hope that you found this information to be helpful. Because in order to plan for somebody else's future, you first need to plan for yourself. Now, it's important to understand that every family's situation is unique. So please make sure that you speak to a financial professional who has specialized knowledge in the area of special needs planning for a more individualized approach. Now, if you liked the information, make sure that you hit that subscribe button and that notification bell, and please share it with a friend. Also, if you liked what you heard today, make sure that you click on that link below to become a client so we can start putting together your overarching financial strategy with your special needs plan. Because remember, planning for your loved one's future today makes for a confident tomorrow.